Have you ever noticed something strange in the market? Sometimes, after falling continuously for several candles, the price suddenly reverses and starts moving back up. And surprisingly, this doesn't happen randomly. There's actually a reason why the market often bounces after moving too far in one direction. Price doesn't move in a straight line forever. It constantly expands away from its average and then contracts back toward it. This behavior is called mean reversion, and today's strategy is designed to identify exactly these moments using two powerful indicators: Bollinger Bands and the Stochastic Oscillator. Let's start with Bollinger Bands. Think of the middle band as the market's average price over the last 20 candles. The upper and lower bands expand when volatility increases and contract when the market becomes calm. Now here's an important point. Many beginners think that if price touches the lower Bollinger Band, it automatically means it's time to buy. That's completely wrong. The Bollinger Bands don't tell us that the market is bullish or bearish. They simply tell us that price has moved unusually far away from its recent average. But markets can remain overextended for much longer than we expect, especially during strong trends. So, how do we know if sellers are actually losing control? That's where the stochastic oscillator comes in. Unlike Bollinger Bands, the stochastic doesn't measure volatility. Instead, it measures momentum. It compares the current closing price with the recent trading range and gives a value between 0 and 100. When the stochastic falls below 20, it tells us that the market has been closing near the bottom of its recent range. In other words, selling pressure has been dominating. But even here, we don't enter immediately. A market can stay oversold for a long time. So we wait for one final confirmation. The %K line, which reacts faster, must cross above the slower %D line while both are still below 20. This crossover is our first sign that buyers are beginning to regain momentum. Now think about what we've combined. Price is trading at an extreme, far below its average. Momentum shows that sellers may be exhausted, and buyers are starting to step back into the market. When all three conditions align, that's when we look for a buy entry. For the exit, we simply wait until price reverts back toward the opposite extreme and reaches the upper Bollinger Band. Or, if the stochastic moves above 80 and the %K line crosses below the %D line, it suggests bullish momentum is fading, making it a good time to exit. One final thing to remember. This is a mean reversion strategy, so it performs best in sideways or range-bound markets where price naturally oscillates around its average. During strong uptrends or downtrends, price can continue riding the Bollinger Bands for a long time, producing false signals. That's why understanding the market context is just as important as understanding the indicators.